Good evening, everyone. Welcome to our UC Irvine Alumni Homebuyer Workshop. My name is Jason Maida. It's great to be with everyone this evening. Thank you so much for taking time out of your busy schedules to get a chance to learn a little bit more about home ownership. This is a very interactive session with a runtime just about a little bit less than an hour tonight in our class. We appreciate you taking time out of your busy schedules to be able to join us tonight. And so hopefully you're going to learn a lot of great things to help you on that path towards home ownership. We've had the pleasure of presenting this content to our UCI alum for the last 5 or 6 years. We teach this class once a quarter, so it's offered once a quarter, and we have really great participation from the community. We're really proud to be able to bring this to you. A little bit about me. My name is Jason Maida. I'll be your presenter this evening. And so I'll be walking you through our presentation on home buying. We work for an organization called American Pacific Mortgage. We're the 9th largest lender in the country. We have the pleasure of being the #1 producing team within American Pacific Mortgage. So really grateful for that designation. We are really passionate about serving our communities in home ownership. We do that through our educational platform, which you are all a part of this evening. So, you're going to learn a little bit more about what it looks like for home ownership and being prepared for home ownership in tonight's class. And we'll talk a little bit also as like, what does it look like as next steps for you? And so let's look at a little closer at our talking points for tonight. We're going to spend some time looking at a budgeting exercise in just a little bit. We're going to kind of talk a little bit about what does it look like to rent versus what it could look like if I decide to purchase at some point in time. We'll also spend some time looking at the housing market, both from like what are home prices looking like in the Southern California markets, but also let's talk a little bit about what our interest rates are doing and how that's influencing buying behaviors right now. We'll talk a little bit about credit and preparing your credit for home ownership to maximize your buying power and obviously the least amount of financing cost. Talk a little bit about loan programs and how those can support you in home ownership. And one of the challenges in home ownership can be just savings for home ownership. Now, we're going to spend some time talking a little bit about a savings plan to help create enough resources for you to meet some of the requirements for homeownership, as well as first-time homebuyer programs that are available to you. So for those of you that are in tonight's class that maybe live in the California markets, there's some wonderful first-time homebuyer programs to help you. We happen to be one of the leading providers of those. So we'll kind of share with you some resources and assistance programs. We'll also talk a little about the buying process. So after tonight's class, you may want to learn about how do I go through the milestones of buying? How do I achieve the keys to my home? We're going to walk you through our 6 steps of home buying and kind of share with you a little bit more about a consultation and what that can look like you to design your own path towards home ownership. Well, tonight's class is a very interactive class. So, we encourage you, ask us questions as we go through tonight's content. You can do that by either using the chat feature within Zoom, or we'll go ahead and take questions within the Q&A as well, too. So either one of those ways, you can get connected with us and we'll answer those questions on air. Now, another housekeeping note, we are recording tonight's class. So if you have to step away or whatever, we totally understand. But we are going to have this recorded up on our YouTube channel tomorrow. We're also going to be taking all the presentation material, sending it back into you via email, and we'll certainly stay in touch with you after this class is over. So that's what our plan is for tonight. Again, we're going to take us up right about to the top of the hour, and we'll answer all your questions as we go through tonight's course. So let's talk a little bit about buying. Does it make sense for me to consider home ownership? Now, things are a little bit more expensive these days, but is it reasonable to think I can obtain home ownership? And when we consider home ownership, the things that I would encourage you guys to think about is, home ownership can create better stability in your housing expense. So when you think about renting, you're, kind of at the mercy of the landlord potentially increasing the cost of rent, whereas a homeowner, you kind of control your budget on a monthly basis. Now, those that choose to purchase in today's market at higher elevated interest rates, there will be an opportunity to refinance at some point in time when rates start to slide. Hopefully that's in the next 1 to 2 years. But ultimately, if we can afford to get in today's market, we can create potentially a better budget for us as it relates to our housing expense long term. Now, this is an asset that should grow over time, right? So as that home goes up in value, as we make our mortgage payments, continue to pay down our balance, the difference between our value, market value versus what we owe on our home is called home equity, right? And for most of us across the country, it's probably going to be one of the biggest assets that we have. And so that asset has the opportunity to create generational wealth for families across the country. Now, there's also tax benefits that come along with owning a home. So potential tax deductibility of interest. And when I look at maybe the improvements I decide to make in my home, like energy efficient improvements, those can also be potentially tax deductibility when you're a homeowner. So a lot of great things that can come out of home ownership. And so as we look a little bit closer at comparing renting versus owning, we like to dive into what we call as a rent versus buying calculator, just to help us better understand how do we factor in like the benefits of home ownership, comparing that to where I'm at from a rental perspective. And when I kind of look at that comparison, does it even make sense for me to proceed? And so we're going to kind of move over to our rent versus buying calculator. I'm going to walk you through the exercise right now. I would encourage our class to take a peek at this calculator once you get the presentation material tomorrow. Run your own calculator, but I'd love to kind of walk us through like a what if scenario using this calculator. So if we have a scenario where we have a client that's spending, let's say, $3,000 a month in rent, let's say we have an expectation of maybe $15 a month in renter's insurance, and we assume that our rents are going to go up 3% on an annual basis. So that would be our backdrop for the rental scenario. Now, we're going to compare that against home ownership, right? So if we look at our home ownership tab, which I'm going to drop into over here, we assume, let's say we buy a $700,000 home. We have a minimum down payment of 3%. Now, we're going to learn more about loan programs and some of those minimum down payments tonight. But the minimum down payment on a conventional loan is 3% of the purchase price. We have property taxes for the home. We have the homeowner's insurance costs, which will obviously vary based upon what part of the country you're in. And then we have maintenance costs. We want to kind of bake that into our equation as well. All right. And then we have loan information. So we're going to look at, more than likely probably a 30-year fixed mortgage, average interest rate of about 6.5%. And then when we think about the cost of obtaining financing, those are called origination costs. Now, one of your benefits in addition to our classes that we provide to the UCI alum is that we actually discount our origination cost by $750 just to create better affordability for our future customers. Now, discount points is the next section I would just want to quickly cover, because you see that a lot in today's market where we're at elevated interest rate levels. Discount points allow a consumer to pay additional funds out of pocket in order to bring down that level of interest rate. Now, it usually takes about 3 to 4 years to break even on discount points. And that discount point is usually the equivalent of 1% of my loan amount. So if I finance $650,000, for example, one discount point would be $6,500. That would usually bring down a mortgage interest rate about 0.25%. Now, the reason why it's a 3 to 4 year break even, because it's going to take that much time to recoup that investment. But most clients in today's market that decide to purchase are probably going to refinance in a couple of years. So that's why I don't really think discount points make a lot of sense in today's market. But certainly some clients just need to achieve a lower level of payment. Now, we also have other settlement services. We're factoring in there title, escrow fees. We also want to look at what are some of the taxes going to be for the transfer of the sale of home. All of those things get lumped into a category called closing costs. And closing costs in total, along with prepaid items to buy a home, usually run about 2 to 3% of the purchase price. So that's usually what we would expect the budget to be, 2 to 3% of the purchase price. Now, last assumptions we're going to make is the appreciation rate of my home, how long I'm going to be in this house, what the cost of selling my home at the end of 7 years, because I'm going to kind of show you a side-by-side 7-year comparison. We have state and federal tax rates, and then we just kind of plugged in a savings rate of 1%. I know realized savings rates are a little bit higher, but this will kind of just give you a little bit of a illustration of what this looks like. So if we were to compare the payments of renting at $3,000 a month versus owning, now we're going to step up that budget quite a bit. We're going to go to $6,000 a month from a housing perspective. If we buy, now it doubles up our outgoing expense, but our total cost opportunity over 7 years would lean towards the buy side of about $67,000 if I own that $700,000 versus continue to pay my rent on an annualized basis. Now, so when we think about that, those are, we factor in the tax deductibility of interest into that mortgage calculation. We also factor in appreciation of my home, which again, that's going to be probably one of the largest growth components of assets for most families across the country. And so when we think about home ownership versus renting, it's really not an apples to apples comparison, because we really want to factor all of those key elements that make up the opportunities within owning. Okay. Now that of course looks a little bit different for everyone in their scenarios. That's why I would encourage you when you get our presentation material tomorrow, take some time to go through that calculator. I think you'll find that to be a really good experience to just understand a little bit more about comparing your current situation against the future of home ownership. Now, as we look at the housing market, obviously that's going to play a role in maybe my timeline of buying. It could be, because maybe the market's too expensive for me and I'm waiting for prices to decrease or whatever the case may be. The housing market is, currently right now in kind of the spring and summer and soon to be summer buying season, right? Now, traditionally, we see the busier times of the housing market in April to August. And the reason why we see that is because, we're having families that are looking at moving neighborhoods because of school districts, perhaps. Maybe we're seeing job relocations. It's warmer weather in most parts of the country, which obviously brings more sellers to market, more buyers active in the market. And, we're kind of in an uncertain time economically. And so I think that uncertainty can lead to some opportunity in today's housing market. Obviously in the LA market, we've had, some devastation with the fires most recently in the last few months. And so we have a lot of families that are displaced from that perspective. So if you look at some of the pressure that's put on the housing market, we've had our own clients trying to find new homes. And so that affects our local LA housing market, maybe to a certain extent, a little bit of the Orange County market too. But when we look at that housing market, we are seeing some trends that are, even with the demand that still exists out there, we are seeing homes stay on market longer. You can see average median days on market is 67 days right now in the housing market. Across the country right now, inventory levels are up 33% year over year. So there is more supply out there to support buyer demand. So, I think that's where you probably see a little bit of like an edge downward in the median price that you're seeing in the LA market right now. You might say it's a little bit of a softening right now, but it still remains somewhat competitive. Now, as we kind of push forward out and continue into the spring and summer buying months, we will hopefully see more and more buyer activity in the market. Inventory, obviously, we're up in inventory. LA is not necessarily in line with the rest of the country, but there certainly is more supply coming on market and it's sitting longer. So what I would kind of encourage future buyers to think about is when we enter markets like this, where we see a little bit of softening in the data, it could lead us into what we call as a buyer's market. And there is some other indicators that show that it could be a buyer's market across the country, in that 44% of all transactions being done across the country includes some type of seller concession, maybe price cut or sellers contributing towards out-of-pocket expenses. So if we're financially ready, there could be some alignment for buyers to enter today's market, given what we're seeing in some of the data points within the housing market. Now, interest rates are also going to play a major role, right, in our buying power, our qualifying, and is it the right kind of entry point for us into the market. Now, interest rates remain at elevated levels currently. We gave you kind of a snapshot of the last 12 months of interest rates along with the last 20 years of interest rates. Interest rates have been very choppy right now. They've been kind of up and down based upon the on again, off again situation with tariffs. We are currently at elevated interest rate levels because of the Federal Reserve trying to manage down inflation. The inflation goal is 2% mandate by the Federal Reserve. The other kind of component to lowering interest rates at some point is to have a controlled labor market, an improved labor market. And so we're watching that really carefully, but the tariff dynamic has definitely played a major volatile push into interest rate markets. So 4 weeks ago, we were at interest rates as low as 6.3. Fast forward to today, now interest rates are at 6.8, almost 7%. So it's a really up and down market. The interest rate market looks very similar to 20 years ago, believe it or not. Now, home prices looked a lot different at that time. They were a fraction of what they are today, but similar levels. Interest rates will cycle down. So that inevitably will happen as we see inflation get closer to that 2% goal. The Federal Reserve will cut rates. That will ripple effect into mortgage interest rates. I do think we'll still remain at these higher levels throughout 2025. And then as we kind of transition into 26 and 27, we'll see hopefully rates dipping into the high 5% range. Historically, rates remain in that kind of that low 5s to high 4 range. That's kind of the historical average that we generally see. But as we move forward and as interest rates go lower, the buyer demand will pick up inevitably. So what we generally see is as rates go lower for a buyer, they are going to be more apt to come back into the market as rates go lower. The opportunity, I think, as I mentioned earlier, with this uncertainty we have in the markets, some buyers that are financially ready and can still handle the housing budget at elevated interest rates will potentially have a bit of an edge in today's market, because as more buyers re-enter the market with lower rates, that obviously creates more competition, potentially higher priced homes. All right. Now, when we think about interest rates, there's various characteristics that go into interest rates. So it's not like a one size fits all with interest rates. Things like credit score and eligibility, the type of program I'm going to do, how much I finance, what my down payment percentage looks like. We talked a little bit about discount points. So that's my opportunity to bring down that interest rate, but it does increase the expenses at the same time. And if I decide to go from a traditional 30-year fixed mortgage to, let's say, a 20-year, maybe even a 15-year mortgage, that can help bring down my interest rate. Now, as I get a chance to meet with our clients from our classes throughout the country, we're going to figure out the right option for you and customize a home buying plan for you based upon your goals and objectives for homeownership, and kind of talk through what interest rate options look like for you. But ultimately, those are kind of some of the characteristics that go into interest rates. One of the major factors in interest rates is credit. And as we prepare for home buying, we want to make sure we inform our clients, what does the credit look like? Is there areas of opportunity? So we always take time out in our classes to dive a little bit deeper into credit, just to give you some awareness of those areas of opportunity and really understand how we kind of look at credit. Now, every loan program has a minimum credit score requirement. We've included some of those loan products on screen here. You can see some of those minimum credit scores. This CalHFA program is a state-specific program. So I think most of us are joining us from California. The CalHFA program is the California Housing Finance Agency program. We're going to spend some time talking about that a little bit later in tonight's class. But every loan program has a minimum credit score requirement. Now, there is 3 different agencies to credit scoring, as you're all aware of: Experian, Equifax, and TransUnion. They all have different credit models based upon the type of application you're submitting. So there's a credit card model, auto finance, there's a mortgage model. Of course, in the housing space, we're going to use the mortgage model, and we're going to take a look tonight at what the risk factor looks like, or the weighting, I should say, as it relates to the mortgage credit score. Now, as we think about how long items are going to appear on our credit report, like events, let's say negative events, they're really going to have a lasting effect on the score of the most recent 12 to 24 months from the event. As I have bigger events, like maybe a bankruptcy or short sale or collections, those can have a longer lasting effect. But generally, within the most recent 12 to 24 months from the event, that's when you're going to see the impact to your credit score. Tonight, we're going to talk in just a minute about credit utilization, comparing your credit card balances versus the credit limits. We'll talk a little bit about account closure in our next discussion. And then when we look at the credit scoring, there's 3 different scores that come out across the agencies, right? Now, we always take the middle credit score of all 3 agencies reporting. So if my highest score is 760, my middle score is 740, let's say my lowest score is 720, we're going to take 740 as the middle credit score for qualifying purposes. Now, let's say I'm going to apply with my partner, but my partner's at 700, 680, and 660. Well, my partner has the lower middle score between the 2 of us. So in that scenario there, we would take my partner's score of 680. That would be the score we would use from a qualifying perspective. Now, let's kind of quickly dive into a little bit of a matrix here that I'm gonna share with you guys. This kind of shows with you how long negative items will remain on your credit report. So let's say I had a late payment on my student loan back in 2023, in October of 2023. Now, it's probably, because I'm almost 2 years away from that event, my score has probably seen some recovery, but it will remain on my credit report for the next 7 years, or 5 more years, I should say, given what I'm sharing with you on screen here. So this is kind of a matrix to show you how long negative items will appear on your credit report. But in the most recent 12 to 24 months from the event, that'll have the impact into your credit score. Now, when we think about the mortgage score calculation and the weighting, I want to kind of dive into each one of these elements so you can better understand what the mortgage credit score looks like. And so 15% of the score is going to be how long have I had credit. So the longer, more mature my credit file is, probably the higher my credit score is going to be. If I've had credit for 6 months, it's probably a lower credit score than someone that's had a credit for the last 6 years, right? Now, as it relates to closed accounts, we're talking specifically about revolving accounts. So if you decide to cancel out a credit card, right, you just close it out because you're not using it, maybe the annual fee is too high, whatever the case may be. Once you close out that account, the key with this is that when you close it out, it actually pulls away all the history from your credit file and also eliminates a credit limit that's available to you, right? So I would say, as guidance for our class tonight, be careful closing out accounts, even if you're doing balance transfers or switching relationships for better benefits, because it could have a negative impact on your credit score by that closure. Now, the next weighting is 20%. That's how much new credit am I trying to apply for. So if I'm trying to open up a bunch of new accounts, especially in the last 6 to 12 months, we want to be careful of that because that could have a negative impact on my score. Now, there's also inquiries that are in this section. So when you apply for credit, an inquiry is done. That's generally a hard inquiry, which can have an impact to your credit score. In auto financing and mortgage financing, there's a rule that creates a 30-day window of time to apply with as many lenders as you want, right? So let's say I go out and want to buy a car, right? When I have day one of my first inquiry, I have 30 days to shop around with as many lenders as I want. It's the equivalent of one credit inquiry hit to my score. Now, in our approach to helping our clients in financing, we only start with a soft inquiry, which does not impact your credit score. And the reason why we choose to do that is because many of our first-time buyers are just trying to figure out a game plan towards homeownership. They're trying to figure out what does this look like. And so we want to help explore options with them without negatively impacting their credit score. 30% is going to be around credit utilization. So we're looking specifically at revolving accounts. And in that view, we're looking at your balances versus our credit limits. So let's say I have $10,000 in total limits on my credit cards, but I'm at $5,000 in balances, right? So currently I'm at 50% utilization. Well, let's say I've just recently added more charges and now my balances moved from $5,000 to $8,000. Now I'm at 80% utilization. So that's probably having some pullback on my credit score. So for our client in that scenario, we would really encourage them to get those $8,000 in balances reduced down to say $5,000. Once we've got to that level, then we really want to try to work towards getting to $3,000 in balances and ultimately try to keep those credit cards at $1,000 or less in balances. Now, so 10% is ultimately the optimal level or less in credit utilization. Now, as you're looking to try to manage down credit card debt and maximize your credit score, here's my tip for you in tonight's class. If you can take some time to take a look at your credit card statement, there's two dates there. There's the statement date. There's also the due date. Now, most of us probably make our payments on the due date, which is great, but I would ask you to kind of change that up a little bit. Try to pay down your credit cards or hopefully pay them off before the end of the statement date, because the statement date is when the credit card issuer sends out all your account information to the agencies. If you can get ahead of that and pay down the account, now you're going to have a much more lower balance reported out to the agencies. You create lower utilization for yourself, and then in effect, get a higher credit score. All right. Last component is payment history. We're simply looking at how have I paid my bills, right? If you've had a late payment, it's going to affect the score in the most recent 12 to 24 months. Late payments are rated as 30-day lates, 60-day lates, and then 90-plus day delinquencies. The more significant my delinquency of 90-plus days delinquent, the bigger impact it's going to have on my credit score. All right, so in looking at credit reports and different accounts that show up for clients, student loans inevitably obviously show up for most of our clients. Now, most federal student loans are in forbearance right now due to kind of the pending litigation on the forgiveness of student loan debt. I'm hearing rumblings that they could come back online with payments in the next 60 to 90 days. But at this point, everything is in forbearance as it relates to federal student loans. So when we view things from the lending perspective, there's a couple of different ways we still have to calculate payments in for qualifying for home financing. So even though we're not making payments and we're in forbearance, as a lender, I do have to take into consideration a minimum payment for qualifying. So let's say I have $75,000 in student loan debt and I'm applying for an FHA loan. I would have to factor in 0.5% of those balances as the monthly payment, which would essentially be $375 per month. Now that's on an FHA loan. If I'm going to apply for a conventional loan, I take 1% of the balances, which would be $750 a month. in monthly payment that I have to qualify for. Even though I'm in forbearance, even if I'm in deferment, in the lending guidelines, we still have to count a minimum payment for qualifying. Now, if I'm on an income-based repayment plan and I'm paying $250 per month, that payment can be used for qualifying as long as I'm in active repayment. If I have payments that are deferred out till 2027, we're still going to have to use that minimum calculation of either 0.5% or 1% for qualifying purposes. So just kind of takeaway in our student loan section is that, if you're in deferment or forbearance in lending, we're going to have to factor those student loans into the overall qualifying. Essentially, what we're looking at there is we're trying to understand your expenses versus your income, which is known as debt to income ratio. Now, the reason why we take a look at student loan payments is because within the underwriting guidelines for loan programs, there's various things that we have to identify, right, and understand from a client as we build a home buying plan. Now, I want to spend some time talking a little bit about loan programs for our class tonight and give you kind of a high-level look at what loan programs resources are available to you. So let's kind of dive into each one of these through our product section here. And the first one is the conventional loan, which is a Fannie Mae or Freddie Mac loan. As first-time buyers, we have a minimum down payment of 3%. Minimum score to achieve a conventional loan is 620, and the maximum loan amount goes up to 802,650. Now, I realize since we're teaching primarily a California class, we do have high cost of living areas in California, like Orange County, LA County, San Diego, go up to Northern California. So those loan amounts can actually go higher. The highest we can go up to is $1,209,000. That's what we call the high balance limit. However, when we stretch beyond that maximum loan amount we have on screen of 802,650, the minimum down payment goes from 3% to 5% when we get into the high balance loan space. The FHA loan is a government insured loan. That's the next product. It's a minimum down payment of 3.5%. Minimum credit score of 580. Now, the max loan amount on FHA is a little bit different. The loan amount gets set by county, but if you're going to use FHA and purchase in a high cost of living area, you will have, like LA County can go up to $1.2 million plus. Okay. Now, with the FHA loan, it is a government insured loan. FHA stands for the Federal Housing Administration. Now, these two products, both FHA and USDA, are both government insured loans. Now, there are some changes that are rolling out this month, which basically states that you must be a permanent resident to access these government insured products. So that's unfortunately a guideline has recently been adjusted. If you're a non-permanent resident, we can still do a conventional loan. So that's a Fannie Mae and Freddie Mac loan. But unfortunately, right now, if you're a non-permanent resident, we don't have access per the guidelines with FHA and USDA. The next product is the jumbo loan. The jumbo loan is going to be for clients that need a little bit more buying power that stretches beyond maybe the bandwidth of Fannie Mae and Freddie Mac. It does have a higher down payment, 10 to 15% down payment, minimum credit score of 700. There's also some higher asset requirements, not only just down payment, but reserve requirements that are attached to a jumbo loan. The VA loan is our next product under review, and that's for our veterans that have eligibility on the VA home loan. It's a zero down payment option, minimum credit score of 620, a lot more flexibility for the veterans when we look at expenses versus income. There really is no maximum loan amount. In fact, here at APM, we can go as high as $5 million with a zero down payment option for the veteran. We want to make sure the veterans have an entry point to home ownership, and so that's why this product is much more flexible to encourage home ownership for the veteran. We kind of touched on the USDA product, but I'll kind of give you a little bit of a deeper dive. USDA stands for the United States Department of Agriculture. It is a government-backed loan, zero down payment option. It allows buyers to purchase in more rural areas. There's two qualifiers to USDA. There's the location, so it has to be deemed a rural area by the USDA. There's also income limits based upon your household size. Now, one product we don't have on here that may be applicable for some of our class is our physician's loan. The physician's loan allows us to take a different look when it comes to student loans. So we don't have to count student loans again. It's what we call debt to income ratio. Also allows some flexible down payment options. So for lesser amounts, especially for physicians that are looking to purchase at those higher price limits. Okay, so that's the physician's loans that's available. Let's talk a little bit about PMI or mortgage insurance. Now, you may have heard a lot of information about PMI and mortgage insurance in general. I want to do a deeper dive in comparing mortgage insurance from both the conventional perspective as well as the FHA loan. So let's first of all explain what PMI is. PMI stands for private mortgage insurance. Private mortgage on a conventional loan is sure and certainly, it actually insures lenders against default by the buyers. So there's about 7 or 8 different private mortgage insurance companies that essentially insure the lender against default by the buyer. Now, the buyer does pay for the PMI, and it comes into play when we put less than 20% down on a conventional loan. Now, on an FHA loan, it's called MIP, or mortgage insurance premium. So let's learn a little bit more about the characteristics of each one of those mortgage insurance components. The conventional loan, when we think about PMI, has 3 factors that make up the cost that I pay for it as a buyer. 1 is my down payment, 2 is what my credit score looks like, and then how much I finance is the 3rd component. So the higher my credit score is, the higher my down payment is, the lesser my mortgage insurance costs are going to be. Now, if any of our classes started their home search already on Zillow or Redfin, maybe you've used some of the calculators that they have available on their sites. We want to be cautious with those calculators because many of the mortgage insurance premiums that are noted are quite inflated. And the reason why they're inflated is just because they're kind of like generic scenarios, whereas you're going to get, when we actually calculate out a payment, especially using one of our calculators, it's going to be built by these 3 components: down payment, credit score, and amount financed. So, really, mortgage insurance is not as expensive as you might think. And I'm going to walk you through an example here in just a minute. But I also wanted to point out that conventional mortgage insurance does have a cancellation option. So when I achieve 2 years in my loan and have 20 to 22% equity, I can apply to have mortgage insurance canceled. So if we look at an example of conventional PMI, let's say we financed $700,000 and I put down 3% to buy my house and I had a 740 credit score, my PMI is about 209 per month. So certainly not as expensive as you might think. Now, the higher I can get my credit score, maybe the more I can put down, the lesser that cost could be. On the FHA mortgage insurance premium side, it looks a little bit different because we have monthly mortgage insurance on an FHA loan, which is 0.55% of my loan amount. Then I also have upfront mortgage insurance, which is 1.75% of my total loan amount. Now that gets added into my total amount finance, but the expense structure is quite a bit higher on an FHA loan versus a conventional loan. On the FHA mortgage insurance product, it cannot be canceled unless we decide to refinance into a conventional loan. Most of our clients that are going to elect an FHA loan today, we're going to really use that as the bridge product, so to speak, to be able to get entry to home ownership. And then maybe when my credit improves, my expenses maybe lower a little bit, we want to try to transition into more of a conventional loan product for all the benefits that I highlighted earlier. Here's what the example looks like of taking that same $700,000 loan amount. Now, factoring it under FHA, you have your upfront mortgage insurance premium of $12,250. That gets added into your amount finance, and then you have your monthly mortgage insurance premium of $320 per month. One of the things I see quite often in the marketplace, and if you do an interest rate search, for example, FHA rates will show much lower than a conventional rate, maybe by 1/4 to 0.5% interest rate. But the thing that's not visible to the consumer is the expense structure on the FHA loan. So FHA loans, while they really support our buyers' entry to home ownership, they will carry with an expensive structure, more expensive cost structure. But at the end of the day, as we get a chance to meet with clients to design their own home buying plans, we're going to figure out which product is really the best match for you to achieve your goals in home ownership. Now, one of the things we're going to also talk about during a consultation we want to learn a little bit more about is, what are some of the things that we want to be aware of from an income perspective? And before we kind of talk a little bit about that, I want to share with you guys some of the general documentation that we ask for of buyers that are looking to start the path towards home ownership. So we've kind of highlighted them here. You can see them noted. Now, if you're self-employed, we will need to see the last 2 years of tax filings for the qualifying purposes. Now, let's talk a little bit about income. And so, when we take a look at income, we're always going to assess the last 2 years of income for a buyer. However, a buyer doesn't necessarily have to be on the job for 2 years. We can have someone that may say just graduated from UCI in the fall and now they just started their job January 1st. As long as we can put together a 2-year history between education and or income, we can use that income for qualifying purposes. Even if I have a scenario where, let's say I'm getting ready to start a new job or I have a new promotion at work, even though I haven't been in that role or in that organization for the last 2 years, we can still potentially use that income to help with qualifying purposes. Now, where it does get a little bit more challenging is if I'm self-employed, I do have to show that I've had my business and I've had tax filings for the last 2 years in order to qualify for financing. Also, if I have additional sources of income, like let's say I have dual employment, maybe I work for 2 different organizations throughout the week. I work 30 hours at one, 20 hours at another. In that case, I do have to show that I worked at both jobs simultaneously for the last 2 years. Now, if I, let's say, have a 40-hour work week job and I also drive for Uber or Lyft as my weekend job, if I want to introduce and use the Uber income to calculate into my home buying scenario, then I also have to demonstrate that I've been on both jobs for 2 years. So those are important things to think about in home as you prepare for home ownership. We're obviously going to help you through that during our consultative process. Last thing I want to touch on from an income perspective is if you have other sources of income, let's say you have a roommate that's helping contribute, or you have a partner that's also contributing towards your household bills. The only way we can use, say, a partner's income is if that partner is going to be a part of the application, then we can factor it into the qualifying. And then rental income or room and board that maybe a roommate's paying, that cannot be factored into the qualifying for the mortgage. There's some products that will allow that if you're purchasing investment property, but for the most part, it's not going to be allowed in more of your traditional, conventional, or FHA loans. All right. We're going to talk really quickly about expenses versus income. So when we assess buyers' eligibility, we look at expenses versus what their pre-tax income looks like. So I always like to walk our classes through the debt to income ratio calculation so you can better understand how we measure eligibility for home ownership. So we're going to calculate in this equation the housing expense that you're going to be having in the future, along with my existing bills, things like credit card debt, personal loans, car loans. Those all get kind of factored into the equation, and then we compare that versus your pre-tax income of in your application. Now, let's take a look at kind of some of the components of that calculation. So we have PITI, which stands for the principal, interest, taxes, and insurance for your house payment. We have private mortgage insurance if I'm going to put less than 20% down. If I'm buying a condo or a townhouse, I have HOA expenses that would be a part of that household expense. And then, like I said, we're going to add in those other expenses. So we provide you with a little bit of an example here. So there's $2,500 in housing expense. We have someone that has $500 in debt, and then we divide that by their pre-tax income of $8,500. So in this scenario, we have a client that has a 35.3% debt to income ratio. Now, one of the questions I get is, Jason, where should my debt to income ratio be? Well, the maximum qualifying is 45 to 50%, so it's quite a bit higher. I would say the sweet spot, if you will, would be somewhere around 33 to 36% is generally kind of the comfort zone for most buyers. That obviously changes a little bit based upon where you're going to buy in the country. If it's a higher cost of living market, maybe you have some additional sources of income that can't be validated. All those things can influence really what your true debt to income ratio is. But we use this as a metric for qualifying. It doesn't necessarily dictate affordability. Those are conversations that we're going to have together as we consult with you to figure out really what home buying looks like for you. The last thing we want to talk about before we kind of go through the process in tonight's discussion is talk a little bit about savings for home ownership. When I think about preparing our clients for home ownership, there's usually 2 challenges to it. Could be around credit, just because we're a little bit overextended with debt. Maybe we're trying to pay down some debt currently, or we just lack savings, right? Maybe we're new in our careers. We're still trying to figure out our financial footing with our new careers. Maybe we just haven't had a chance to save enough. So I want to walk you through a savings plan in just a couple minutes. But before I do that, I wanted to share with you some of the general accepted sources of assets. If you're already there from a savings perspective and you want to kind of know, are these sources that can be used? Well, of course, checking and savings accounts can be used. We do have to validate the last 60 days of accounts to make sure that they're allowable in financing. Cash deposits can't be used in a transaction, so we always have to paper trail everything in financing. And any type of large deposits, we're going to have to kind of figure out where do they come from. Now, you can also use 401ks, 403bs can all be used. You're usually borrowing funds against your investment. And also, using brokerage accounts can absolutely be used as well. IRAs would be included in that. I would encourage you to talk to your tax or financial advisor before you access those assets. We certainly don't want to create a tax event for yourself. And gift funds can also be used for your home purchase. And that's where a family member is contributing their funds to help kind of close the gap for you in terms of what's required for your home purchase. Now, there's no seasoning requirement to gift funds. So the giftor, the donor, can gift those funds right away. There is a paper trail process for that. We generally provide the donor with a gift letter that kind of lets us know as the lender who's donating the funds, where are they coming from, and then what's the amount of those gifts. All right. Now, as we kind of prepare for home ownership, like I said, savings can be a challenge for us. So I want to kind of share with our class just a really simple approach to savings that you can start with right now. And so we want to kind of give you an example of what that could look like. Because oftentimes when I meet with clients, they may be paying, let's say, $2,000 a month in rent, and they think they can afford $3,500 from a household perspective on their budget, but they just lack the resources for down payment and maybe closing costs in today's market. So here's a really simple approach to a savings plan that I would encourage you to think more about, is that if I'm paying that $2,000 a month in rent, and let's say when I pay my rent on the first, I create a habit or discipline that I'm paying rent like I'm actually making a $3,500 mortgage payment. So I pay that $2,000 to my landlord. The additional overage of $1,500, that gets transferred to my savings account to begin my savings plan. And as I do that, over 6 months, I have $9,000 accumulated in savings, $18,000 by the end of the year, not including interest that you're going to get on that savings. It's doing that discipline of creating savings for yourself, but it also does another thing. It also prepares you for home ownership, because as you transition from making $2,000 in payments to $3,500, that's a big jump for most of our clients. And so if we can create that discipline by also savings at the same time, it's going to be less of a payment shock for our buyers. And so that's kind of one way to kind of start building that nest egg, if you will, for homeownership. There's also assistance programs across the state that can also support you in homeownership. And so we partner with CalHFA, the California Housing Finance Agency. It's designed to help low to moderate income households achieve homeownership. We're proud to be the #1 lender of CalHFA all across the state. So I get a chance to work with clients from San Diego up to Eureka and everywhere in between in helping design plans with CalHFA. Ultimately, the agency helps provide the resources for things that we've talked about tonight: down payment, as well as closing costs and prepaid items for a home purchase. So let me give you kind of a high level look at some of these programs. The CalHFA MyHome assistance provides you up to 3% of your sales price in assistance on a conventional loan, 3.5% on an FHA loan. And what essentially is, it's a separate loan that we create for you that has a 1% simple interest rate on it, and does not require any payment until you either sell the home or if you decide to refinance in the future. So it's all deferred payment. Now, just last month, we also released the CalHFA MyAccess program, which provides up to 2.5% of your loan amount in assistance that can be used towards reducing your total out-of-pocket expenses for home buying. It also has a 1% simple interest rate, deferred payment. You don't have to pay it back until you either sell the home or if you refinance in the future. And then this program, ZIP, which is noted here, is another program that would be kind of an alternative to the MyAccess program. The difference is that it is a 2% of your loan amount at a 0% interest rate. The MyAccess program is a bond-funded program, so it tends to have a lower first mortgage interest rate as opposed to ZIP program. So generally, if we're going to need that additional resource, we would encourage our clients to look at MyAccess first. The way these programs work, MyHome and MyAccess will stack on top of each other. So generally, we will start with the MyHome product to cover the minimum down payment. And then if we need additional resources, we would add on the MyAccess program. Now, we have other programs available within APM, like our Pathway DPA program. There's the GSFA, or Golden State Finance Authority program. These would be alternatives to buyers in California that maybe not qualify for the CalHFA product, because generally CalHFA will have much lower interest rate offerings, both on the conventional and the FHA product. Let me just give you a quick example of using CalHFA just to kind of understand a little bit more about the mechanics of it. So let's say I bought a $700,000 home traditionally with a normal conventional loan. I would probably need, between my down payment of 3% that you can see on screen and then closing costs and prepaid items, I probably would need about $35,000 to $42,000 to achieve my dreams of homeownership. But if I substitute in the CalHFA resources, it looks a lot different. I would have my home assistance of $21,000, which is 3% of my purchase price. That could cover my minimum down payment, Plus, the MyAccess could also give me resources towards my closing costs. So I could have over $37,000 in assistance that could help support me with that needed cash to close from a home buying perspective. So this is a wonderful resource that can really make homeownership much more of a near-term goal for many of our buyers across the state of California. Now, there are guidelines for the program: minimum credit score of 640 for the FHA product, 680 for the conventional loan. Now, if I'm a low-income housing buyer, if I make less than 80% of the median income, minimum credit score is 660 for the conventional product. We learned a little bit about debt to income ratio tonight. You can see those guidelines of 45 to 50%. One of the unique things about the CalHFA program is we look at applicant income, not household income. So you're going to see the income limits in just a bit on screen, but we look at just the applicant. So if I make $150,000 a year and my spouse makes $100,000 a year, my combined income is $250,000, which would far exceed the LA County limits. If I want to apply just in my name, we could do that and still stay within the income limits. These programs are eligible for any one-unit property, so single-family homes, townhomes, condos, even some of the below-market homes can be compatible with the CalHFA product line. Now, manufactured homes, I get a lot of questions about this. Manufactured homes can be eligible, but it has to be on land that's actually owned. All right. Here's a quick look at the income limits and for all of our Southern California markets, so you guys can check those out. And of course, if you're in different parts of the state or different parts of the country, then we can talk a little bit about different products that are available to you. One other product that we didn't have noted, for those of you that are joining us from LA County, there's the Green Line program that's available for LA County first-time buyers. There are some different income limits for that program, but that will provide an additional $35,000 in assistance. That program is compatible with CalHFA, so that's called the Green Line program. I know we're getting closer to the top of the hour. I appreciate everyone kind of standing by. I want to walk us through the home buying process as we round the corner in tonight's class. And so I want to explain to you the 6 steps of home buying. Now, after tonight's class, if you're interested in figuring out what your path looks like for home ownership, I would love to get connected with you for a free, no obligation consultation, just to help design some options for you around home ownership. Help set some goals and objectives for home ownership. Whether you're looking to buy in the next 2 or 3 months or the next 2 or 3 years, at least provide you with that roadmap for home ownership. Now, what that looks like as a go forward from a consultation is to possibly get pre-approved for your home purchase. And that kind of sets you on that course towards achieving home ownership. Now, a pre-approval is essentially saying that, you are eligible for your financing. And it's a certificate that you could provide to a seller to say, hey, I'm qualified for my mortgage. So if I decide to make an offer on that property, I am fully qualified. Now, a pre-approval is usually good for 60 days, but it can be recertified at any time. When you apply with us for your consultation, your application stays live with us for 2 years. So there really is no rush towards homeownership. We just want to make sure that you have all the support you need to meet your timeline for achieving that goal. Now, step 2 is the home search process. So generally, you'll have a community identified. Maybe you've started looking at homes online. You spotlight 3, 4, maybe 5 homes that you think might fit or check the boxes for you. Then you would go out in person and see some of these properties. We would encourage you to connect with a realtor locally that should, really understand all the important characteristics of a community, like walkability, the trends in the market, what they're seeing in terms of available inventory. All those things a realtor should be able to provide to you, and in addition, be a really good negotiator. We do have preferred realtors across our markets that we serve that we can introduce you to whenever that time comes. But I would really encourage you to work with a realtor to help guide you in finding the right property for you and your family. Now, if we find that right property, and let's say we make an offer to a seller, and let's say the offer gets accepted, then we move to step 3 in the process. That's called entering escrow. So now we've come to an agreement with the seller. The seller says, yes, we've accepted your offer. Now it starts really the processing side of your home purchase and the overall financing. Now, the same day that offer gets accepted, I'm going to give you a call and say, congratulations, you did it. You got your offer accepted. Let me walk you through some of our next steps, and then let's schedule a follow-up consultation. I get a chance to do that 2 or 3 times a day. And, it just really helps our clients really understand what comes next, because especially when you go under escrow for a home purchase, you get a lot of stuff coming at you fast. And so we want to make sure that you understand all the important elements that are part of your home financing. Now, a follow-up consultation with us is where we go kind of through the redesign of your home buying. Now that you're under contract with the seller, we're going to better understand like what's today's interest rates look like, what's my out-of-pocket expense look like, am I hitting the mark from a monthly budget perspective, all those important components for your home buying structure. Now, you as a buyer will also start to see some activities take place and action items really for you. One is you'll be making a deposit for your home. We call that an earnest money deposit. It usually is the equivalent of 1 to 2% of our purchase price, and that gets withheld in escrow as contribution towards your out-of-pocket. Now that deposit is held in escrow under most contracts. We call that the contingency period, which allows you as a buyer to do your homework on the property, which includes getting the house appraised, getting your house inspected, and of course, getting your loan approved. So the contingency period can be as short as 7 days. It can be as long as 17 days on the contract. But ultimately, that deposit you make, that earnest money deposit, is protected while you're in the contingency period. Now, as we continue down these milestones, step 4 is more to the administrative functions of the loan. We verify things like employment, your assets. We're making sure the loan product type is all selected correctly. We make sure we are having discussions with you around interest rates because interest rates change daily. So once you go under contract with the seller, then we're strategically watching the markets to try to time things to secure the lowest interest rate opportunity for you. Step 5 takes us into the underwriting phase of the process. An underwriter reviews all your income and assets and credit and overall qualifying for your financing. They then issue a loan approval. By that time, once we have the loan approval, your appraisal for your home has also come back. That appraisal indicates that the value supports the buying price of your home. You also probably have all your inspection reports back. And so if everything checks out, you feel pretty good about it, then you would do a sign off of your contingency within that contract period. That tells the seller that you've done all your homework and you feel pretty good about this home and you want to move to the final stages. Now that also triggers us to deliver your final closing disclosure, which starts a 3-day cooling off period before you can sign final loan documents in person. Now, everything in our process from the financing perspective is all electronic. Everything is done via e-signature. There's 3 different iterations of disclosures. There's your initial disclosures that you get within 72 hours of your process starting. Then you have your revised disclosures or redisclosure after your interest rate is locked. And then finally at step 5, you get your final closing disclosure. Now, step 6 is the very final stage. That's called the closing of the loan. That is an in-person process. You'll be meeting with a public notary on that day to sign your final loan documents. You also deposit your final funds for the closing at that time. As your lender, will deposit the funds in for the home financing. Those monies get all reconciled with the county or with the escrow company, and then documents are recorded with the county recorder's office. They'll record a grant deed to transfer ownership as well as the deed for the loan. And once that happens and we get confirmation, then you become the official owner of the home. Obviously, it's a huge day of celebration. We're excited to welcome our clients into homeownership. We get a chance to make those calls every day. It's the best part of our day by far, next to teaching our classes, of course. But our relationships with our clients really don't end from there. Part of our aftercare is we're going to be staying connected with our clients to update them on, what's happening with market interest rates. Is there an opportunity for refinancing? So all of our clients are enrolled in our HomeBot system. They also are tracked in our Rate Watch system to make sure we can capture lower rate opportunities whenever that time comes. And we understand that our financial lives of our clients change all the time, right? And so we're always checking in with our clients on an annual basis. So we don't look at home buying in our relationship with our clients as just another transaction. It truly is a long-standing relationship. And we've had, client relationships over the last 15 plus years that we've served in our communities across our markets. Now, if you're thinking about pursuing homeownership, we'd love to be a partner with you on that journey. I'd love to be able to get connected with you for a consultation. Your next step from today's class, if you decide to make that choice, is to complete our Get Started information, which includes just completing a really simple online application. The links are going to be provided in our presentation material. We only do a soft credit check, so you don't have to worry about your score being impacted. And then you'll use our scheduling system to schedule a consultation at your convenience. So we can meet for a 30-minute Zoom session and just map out that plan for homeownership. I get a chance to do that throughout my day. That's what I do in serving our clients in homeownership, not only teaching educational classes like this, but help formulate a plan for our buyers. So we hopefully get a chance to do that for you. Now, if you have some questions after tonight's class and you just want to kind of run some ideas by us, feel free to schedule an introductory call. We'd love to be able to make ourselves available for that as well. Again, our consultations are a free service we provide to you. This is kind of what that consultation looks like. So if you want to kind of map out that plan of where do I want to buy, what's my budget look like, maybe I need to some help from a credit perspective, maybe I want to learn a little bit more about how CalHFA first-time buyer programs can support me in homeownership, we will be there to help you with those resources. All right. Last thing I want to point out to you is our mobile tool. Speaking of resources, you can start your home buying journey all via mobile. You can also use the calculator functions in mobile. Great tool to kind of help you better understand really about what your budget can look like too as well, using some of the calculator features within mobile. Just want to again spotlight our UCI alum discount, which essentially reduces our closing cost by $750 for our home buyers, whether they're purchasing a home or they're considering refinance at some point in time. Our UCI relationship is one of our longstanding relationships that we started educational classes. We used to teach classes in the alumni hall back in the days pre-COVID. And so, this relationship is really special to us, and we want to make sure that we take care of our UCI alum. Now, we do have other partnerships across the country that we serve as well. So if you have friends, family, or coworkers that you think would benefit from our educational platform, these classes are free to our local communities to help understand more about homeownership. And as I finish up, this is all my contact information. So if you want to get connected with me, feel free to reach out using that contact information. Like I said, you can book one of your appointments online through our website. You can see the link there. And so I'm a few minutes before the top of the hour. Thanks those. I know some of you had to jump off. I appreciate those sticking around that you did. As we kind of finish up tonight's class, is there any questions I can help answer from our audience? Any questions at all? I know I'm in between dinner time on a Wednesday night, so I understand if there's no questions, no big deal. But I want to make sure make ourselves available for that. All right. Okay, well, again, this class is being recorded, so if you missed something, I know some of you had to jump off a little bit early. Feel free to check that out on our YouTube channel. The class will be up and running tomorrow morning. We'll also get out that presentation material. Thank you so much for attending tonight's class. I hope that when you do just consider homeownership, that you'll consider our APM team to help you on that journey towards homeownership. And before I leave, I did get a question that popped in, which is, what is the best season for house hunting in the Irvine area? Well, Irvine, unlike other parts of the country, doesn't have the seasonality in weather. So probably every time is the best time, and from a weather perspective in Irvine. But it really just depends. Irvine is a very, very hyper competitive market. I think you could argue that maybe the winter months could be maybe the best time. It's really hard to call it because Irvine is a very competitive market. But I think that's a conversation that I would encourage you to have with a realtor once you get to that point. But my initial reaction would be probably towards the winter time of the year. Just knowing kind of what that market looks like. All right. Thank you. So I got a question. I appreciate that. Thank you so much. And we can certainly connect offline if you want to kind of dive a little deeper into that. All right. Well, thank you so much again for attending tonight's class. Look forward to connecting with you all in the future. And I wish you a wonderful night. Good night.